In October 1987, the market fell so fast that computers froze mid-trade. Traders stared at empty screens. The Dow Jones lost 22% in a single day, the largest one-day collapse in history. It wasn't panic alone that caused it. It was mathematics. Portfolio insurance was supposed to be protection, a formula designed to make investors safe. But in reality, it was a trigger, a perfect feedback loop of automated selling. The very mechanism built to prevent losses multiplied them. And when the computers started selling, there was no one left to buy. Now, fast forward almost 4 decades. The names have changed, the logic hasn't. ETFs, exchange-traded funds, promise liquidity, safety, diversification. You can exit any time, says the brochure. But what happens when everyone decides to exit at once? In 1987, risk was hidden inside formulas. Today, it's buried inside passive structures. Then it was dynamic hedging, now it's index tracking. The illusion is identical, that complex systems can absorb infinite demand for liquidity, that a market can sell itself to safety. Some economists still call the 1987 crash a technical event, but the parallels with what we're building now are too precise to ignore. Back then, computers followed a curve, a simple rule: sell when prices fall. Today's ETFs follow an index, another simple rule: buy whatever is included. In both cases, the human element disappears, replaced by mechanical obedience. And here's the paradox. The more investors trusted the system, the more fragile it became. In 1987, confidence was the accelerant. In 2026, it might be the fuse. Imagine a $1 trillion network of passive capital moving in perfect synchrony. Not thinking, not choosing, just following. What would happen if the flow reversed for 1 week, 1 hour? Some historians see 1987 as an anomaly. Others see it as a warning we never fully understood. Because behind both systems lies the same belief, that technology can cancel risk. But in finance, every safeguard has a shadow. The markets don't crash because we forget. They crash because we remember too late. The story of 1987 didn't begin in 1987. It began with fear, the fear of missing out on returns and the fear of losing them. The early 1980s were an age of innovation on Wall Street. Inflation was tamed, interest rates were falling, and computers were finally fast enough to price risk in real time. The financial world believed it had entered a new era, one where volatility could be engineered, controlled, even sold. The key word of that era was derivatives. Futures and options became tools of precision. They promised flexibility in a market once ruled by instinct. Portfolio insurance, the product at the center of our story, emerged from this optimism. It was born not in a trading pit, but in an academic paper. 2 economists, Hayne Leland and Mark Rubenstein from the University of California, Berkeley, proposed a mathematical strategy that would protect large portfolios from sudden drops. Their idea was elegant. If the market starts falling, sell futures contracts automatically, proportionally to the decline. The further it falls, the more you sell. This way, your losses are theoretically capped, like buying insurance against a crash. Institutional investors loved it. Pension funds, endowments, insurance companies, they all wanted safety without giving up returns. Portfolio insurance offered that promise. The only cost was complexity. But in the 1980s, complexity was fashionable. Brokers and fund managers embraced the method. By 1987, over $60 billion were under this insured strategy, a massive share of the equity market. To the outside observer, nothing seemed dangerous. After all, it was just mathematics ensuring prudence. But beneath that calm logic hid a critical flaw. Everyone was using the same formula. Every insured portfolio would react identically in a downturn. When prices dropped, they would all sell, automatically and simultaneously. The supposed shield against panic was in fact a machine for panic itself. The irony deepened because no one saw the chain reaction coming. Regulators praised innovation. Investment banks marketed it as scientific discipline. Financial media hailed it as the end of irrational fear. Risk, one analyst said in 1986, has finally been domesticated. Yet markets are not machines. They are networks of belief. When thousands of computers began selling futures at once, human traders didn't have time to interpret the signal. They just saw a flood of red. Futures fell first, stocks followed, liquidity vanished. The context was global. Japan was booming. Europe was integrating. The United States, under Reagan, was celebrating deregulation and record optimism. The world's financial arteries were wide open, pumping with new capital and new trust. Portfolio insurance was the invisible valve meant to control the flow. And yet, as it turned out, it didn't control risk, it synchronized it. What looked like diversification was actually concentration. The entire market became one single algorithmic organism, breathing in unison. Today, the logic feels familiar. ETFs, too, were born from efficiency and democratization. They promised access, simplicity, and safety, the very words once used to sell portfolio insurance. Back then, it was a revolution in futures. Now, it's a revolution in indexing. Both innovations started with the same dream, that technology can remove human error from finance. But when too many follow the same safe path, safety disappears. The context of 1987 is not just history. It is a mirror of modern ambition, how every breakthrough begins as control and ends as dependence. Because when everyone holds the same protection, no one is truly protected. It began quietly. The summer of 1987 was calm, even euphoric. The Dow Jones had climbed more than 40% since January, one of the fastest rallies in history. Investors called it the Reagan Bull. The dollar was weakening, exports were rising, and optimism filled every trading floor. No one noticed how tightly the system had been wound. Portfolio insurance worked perfectly, as long as the market went up. Every rise meant fewer futures to sell, more confidence, more leverage. It was an invisible spiral of trust. But like all feedback systems, it depended on a fragile assumption, that liquidity, buyers, would always be there. Then, in October, the illusion cracked. On October 14th, the U.S. House of Representatives proposed new tax legislation that would make corporate takeovers more expensive. Traders interpreted it as a direct hit to the merger boom, one of the engines of the rally. The market slipped 3%. Not a catastrophe, just a tremor. But the computers noticed. According to their formulas, the drop triggered small automatic sales of futures contracts. By Friday, October 16th, selling pressure accelerated. The Dow fell another 4.6%. Futures markets in Chicago began to decouple from the cash markets in New York, a dangerous signal. Futures prices were dropping faster than the underlying stocks. Arbitrage traders tried to bridge the gap by selling shares to match the falling futures. That made the decline in actual stock prices even sharper. And then came Monday, October 19th, 1987, later called Black Monday. From the opening bell, futures collapsed. Portfolio insurance programs activated across the country. Computers sold billions in contracts automatically, overwhelming the system. Market makers stopped quoting prices. Liquidity evaporated in minutes. The very act of hedging, of trying to protect, became the reason prices fell. The Dow Jones Industrial Average lost 508 points that day, a 22.6% collapse. By modern standards, that would be equivalent to a 7,000-point drop in a single session. The S&P 500 lost a third of its value in less than a week. The paradox was brutal. The mechanism designed to reduce losses had amplified them beyond precedent. Telephone lines jammed. Some trading terminals stopped responding. Even seasoned brokers admitted they didn't understand what was happening. The rules had shifted too fast. Futures, stocks, and options were supposed to move in harmony, but by midday they were disconnected. Prices no longer reflected value, they reflected panic translated into code. And yet, despite the scale, no bank failed. No major company went bankrupt. The damage was psychological, a collapse of faith in the idea that markets were self-stabilizing. In the days that followed, investigators looked for a single cause. Was it the computers, the tax rumors, a rumor about interest rates? None of these alone explained it. The truth was structural. The system had become reflexive, reacting to its own reflection. Economist Robert Shiller later described it as a failure of collective narrative. Everyone believed the market was protected, and that belief itself became the risk. Now, imagine today's ETFs through the same lens. They promise liquidity, tracking, diversification. But behind that promise lies a similar feedback loop. When investors withdraw money, ETF issuers must sell the underlying assets to maintain the index balance. That selling lowers prices, which triggers more withdrawals. A modern version of the same reflex. In 1987, futures were the link between stocks and safety. In 2026, ETFs are the link between markets and passive capital. Both systems depend on one assumption, that exit doors remain open. But in a true panic, they narrow instantly. The 1987 crash revealed an uncomfortable truth, that liquidity is not a property, but a mood. It exists only as long as someone is willing to take the other side. What shocked regulators most was not the magnitude of the fall, but its speed. The old world of human reaction had been replaced by mechanical response. A sell signal traveled faster than thought. And yet, within 2 days, the market began to recover. The Federal Reserve intervened with reassurance, pledging liquidity and stability. Confidence returned, not because risk had vanished, but because the narrative had been restored. That day, the financial world learned that speed itself had become a source of fragility. The faster the system reacted, the more violently it broke. The machines didn't fail. They succeeded too perfectly. To understand why 1987 unfolded the way it did, we have to step inside the machine. Portfolio insurance wasn't just a theory, it was a precise algorithm. Its logic was mechanical, almost innocent. When markets fall, sell futures to reduce exposure. When markets rise, buy them back. A moving hedge, adjusting itself every minute. Imagine a seesaw between stocks and futures. The idea was to shift weight automatically, to lean towards safety as danger appeared. In a slow market, it worked beautifully. Small declines triggered small hedges, cushioning losses. But when the market moved sharply, the reaction was exponential. The mathematics looked flawless on paper. If an investor held $100 million in stocks, the computer calculated how many S&P 500 futures contracts to sell to mimic a protective put option. The deeper the decline, the larger the hedge. In other words, falling prices created more selling by design. Now multiply that by hundreds of funds. By the fall of 1987, more than 150 institutional portfolios were linked to this same algorithm. The notional value of insured assets was estimated between $60 and $90 billion, an enormous force in a market where daily trading volume was only a fraction of that. And here was the hidden flaw. The system assumed continuous liquidity. It assumed that futures could always be sold, instantly, at stable prices. But liquidity, like air, thins out when too many breathe at once. When prices began to drop, portfolio insurance programs sent simultaneous orders to the futures market. This flood pushed futures prices far below cash equity prices. Arbitrageurs, whose job was to close that gap, started selling actual stocks. That selling triggered further declines in the indices, prompting even more automated futures sales. The cycle closed on itself. It wasn't manipulation, it was synchronization. Human traders were still in the loop, but only as observers of a process too fast to control. The system had no brake because it was built without one. Its creators had designed a car that could only accelerate downhill. By late morning on October 19th, futures prices in Chicago were in free fall. In New York, the stock specialists, the last human buffers of liquidity, stopped quoting firm bids. They simply couldn't match the flood. The result was an empty market. Everyone selling, no one buying. In that void, prices no longer represented value. They represented the absence of buyers. This is how a theoretical model became a feedback machine, a perfect loop of self-reinforcing logic. It didn't need emotion to cause panic. It generated panic mechanically. Today, ETFs operate under a different vocabulary but a familiar rhythm. They promise continuous liquidity through authorized participants, large institutions that create or redeem ETF shares by buying or selling the underlying assets. The model works as long as markets are calm, but if redemption requests surge, those same participants must offload the underlying securities into the open market, just as portfolio insurers once dumped futures. It's a modern echo of the same design, selling as safety, safety as selling. Back in 1987, few understood that this structure transformed the market from a collection of investors into a single organism. Every move reinforced the next. The result was not chaos, but perfect order, an order that destroyed itself. And yet, even then, the architects of the system insisted it had worked. They argued the formulas were sound. It was the market that had failed them. But markets don't fail equations. Equations fail reality. The mechanism that promised stability had turned risk into rhythm, one that could only end in collapse. If this opened another side of history for you, comment where you're watching from. The day after Black Monday, Wall Street looked like a battlefield without smoke. Prices had stopped falling, but something deeper had broken: trust in the architecture of control. The market had discovered that insurance was an illusion, and when the illusion collapsed, the real system had to step in. The Federal Reserve acted first. Chairman Alan Greenspan, only 2 months in office, released a short statement. The Federal Reserve stands ready to serve as a source of liquidity to support the economic and financial system. 12 calm words, but they changed everything. Those words did not stop the selling immediately, yet they rebuilt confidence faster than any algorithm could. Banks reopened their credit lines. Brokers returned to the floor. By Wednesday, a fragile order had returned. The crash was over, officially, but the consequences were only beginning. In pure numbers, the loss was staggering. $500 billion in equity vaporized in one day. Global markets followed within hours. London down 26%, Hong Kong nearly 45%. It was the first truly synchronized global crash, spreading faster than information itself. And yet the economy did not collapse. Factories kept running. Unemployment barely moved. GDP growth for 1987 ended positive. The paradox was striking. The financial world had burned down, but the real economy barely noticed. This created a dangerous belief that crashes could be absorbed, that the system was shockproof as long as the central bank stood behind it. The lesson that should have been caution became confidence. Portfolio insurance quietly disappeared after the crash, but its logic survived. The industry learned to rebrand it under new names: risk parity, volatility control, dynamic allocation. Each generation of finance believes it has finally tamed risk through precision. Each forgets that precision amplifies correlation. The 1987 collapse also changed the relationship between markets and the state. The Federal Reserve had crossed a threshold, from regulator to rescuer. Every future panic, 1998, 2000, 2008, 2020, would expect the same response: liquidity as salvation, intervention as routine. This dependency became structural. Investors stopped fearing collapse because they assumed policy would always intervene. In economic terms, this is called moral hazard. In human terms, it's faith without memory. For institutions, the aftermath was both humbling and liberating. Pension funds quietly rewrote their mandates, replacing complex hedging with simpler diversification. Universities cut exposure to synthetic strategies. Regulators imposed circuit breakers, automatic pauses in trading to slow future crashes. But none of these reforms touched the root of the issue, the synchronization of behavior. Markets were safer only in appearance. Underneath, the same pattern reassembled, collective confidence built on a single structure. Meanwhile, technology accelerated. Computers grew faster, models more elegant, trading more automated. What took seconds in 1987 would later take milliseconds. Liquidity became a mirage, visible until you needed it. The ultimate consequence of 1987 was psychological. For the first time, humanity witnessed an algorithmic panic, a collapse not driven by greed or rumor, but by logic itself. It redefined what risk meant in a connected world. The official narrative called it a one-day event, but in truth, it marked the beginning of a new era, the digitalization of fear. And here lies the echo that leads us to today. ETFs and index funds are built on the same structural faith that once powered portfolio insurance. That stability can be engineered, that exits will always remain open, that correlation is safety, not danger. The mechanisms differ, but the rhythm remains. In both, liquidity is assumed, not earned. In both, selling is systemic, not emotional. And in both, protection turns into vulnerability the moment too many demand it. Some historians say 1987 was the day the market became self-aware. But awareness is not wisdom. The true legacy of that day is not in the loss, but in the lesson we refused to learn, that every innovation carries the seed of its own undoing. Look at today's markets. Everything seems calm, efficient, liquid. ETFs trade by the millisecond. Spreads are razor thin. Risk, we are told, has been diversified into infinity. Yet beneath that calm surface, the same 1987 rhythm beats, only faster, larger, and quieter. Exchange-traded funds were born from a simple idea: to mirror an index and allow investors to buy or sell it instantly, like a stock. At first, it was a tool for professionals. Today, it is the bloodstream of global finance. Over $11 trillion is now locked inside ETFs, money that no longer chooses, only follows. In 1987, it was portfolio insurance, a mechanical hedge for big portfolios. In 2026, it's passive indexing, a mechanical allocation for entire economies. Then, computers sold futures to stay safe. Now, algorithms buy whatever the index says is right. The mechanism has changed shape, not nature. The principle is identical: automatic behavior in response to price. Portfolio insurance sold when the market fell. ETFs buy what rises. Both amplify trends. Both suppress volatility until they suddenly release it. Some analysts call ETFs the new market infrastructure. That phrase hides a risk. When the infrastructure becomes the market, liquidity turns circular. ETF liquidity depends on the ability of a handful of authorized participants, large institutions, to continuously trade the underlying assets. But when those same assets become illiquid, the ETF's price can detach from reality. It's the 1987 decoupling, only inverted. Imagine a bond ETF holding corporate debt that rarely trades. On paper, it's liquid. You can sell your shares anytime. But to honor that liquidity, someone must sell the actual bonds. In a stress event, say rising rates or credit fears, no buyers appear. Prices gap down. ETFs start trading below net asset value. Panic spreads across portfolios that believed they were diversified. In 1987, it was futures that linked the whole system. In 2026, it's passive flows, silent, automatic, relentless. The structure is global and the feedback loop wider. The pattern repeats: dependence on models, synchronization of behavior, disappearance of liquidity, mechanical amplification of fear. Some historians of finance describe this as algorithmic monoculture. When every investor owns the same thing, there is no diversity, only scale. ETFs have turned the market into a mirror of itself. Every inflow raises the same prices. Every outflow lowers them. What feels like neutrality is, in fact, pressure, invisible but constant. And regulators, once again, believe it's manageable. They point to circuit breakers, to daily liquidity reports, to diversification across sectors. But safety in distribution doesn't mean safety in motion. The 1987 crash wasn't about where money was, it was about how it moved. The ETF world runs on the same illusion, that liquidity is structural, not psychological. But liquidity is human confidence translated into numbers. When that confidence falters, no spreadsheet can restore it. There's another echo. After 1987, the Federal Reserve became the guarantor of stability. Today, central banks have become the largest implicit participants in the ETF ecosystem. Quantitative easing turned them into passive investors on a planetary scale, buying bonds, ETFs, and indexes to stabilize prices. The line between market and policy has dissolved. This is not conspiracy, it's convenience. It's easier to manage perception than to rebuild fundamentals. In the short run, it works. Prices rise, volatility falls, optimism returns. But in the long run, it repeats the same error, equating stability with control. What happens when the flow reverses? When rates rise further, when redemptions accelerate, when safe ETFs must sell illiquid assets to match withdrawals? The answer lies in 1987's mirror, when selling became protection and protection became collapse. Some fund managers already sense it. Liquidity mismatches in bond ETFs, hidden leverage in synthetic products, market makers quietly reducing inventory. The symptoms are there, small tremors in a system built on automatic faith. And yet, optimism endures, because every generation believes its tools are smarter. We have real-time data now, they say. We have AI models. But speed doesn't eliminate reflexivity, it amplifies it. Machines react faster than humans can think, and when they all react the same way, the result isn't intelligence, it's symmetry. The 1987 portfolio insurance collapse was the first mechanical panic. The 2026 ETF crisis, if it comes, will be the first passive one. The same narrative, upgraded in software. The deeper truth is that markets have evolved from decision systems to imitation systems. Risk has not vanished. It has been redistributed into invisible harmonies. We no longer fear crashes because we no longer believe in individuality. But systems built on imitation are brittle. They don't crack gradually, they shatter suddenly. History doesn't repeat, it recalculates. The story of 1987 never ended. It changed its syntax. What was once portfolio insurance became index tracking. What was once a crash became an algorithm. The names shifted, but the belief remained that the system could outsmart its own nature. Every era hides its vulnerability inside its greatest innovation. In 1987, it was dynamic hedging. In 2026, it's passive liquidity. Both promise protection. Both forget that protection is not the same as safety. When markets move in unison, the illusion of diversity is complete. Everyone feels independent while following the same current. It's not a conspiracy, it's geometry. Capital flows to where it already is. Models amplify the familiar and erase the unexpected. Until one day something no model predicted happens, and silence falls again, just like that Monday morning decades ago. Perhaps this is the real pattern, not repetition, but belief cycling through new vocabulary. Every generation builds a smarter structure only to rediscover the same weakness, that risk cannot be hedged away, only transformed. The 1987 collapse was not a failure of technology. It was a failure of imagination, the refusal to see that systems designed for safety are also systems designed for fragility. And if the ETF era ends the same way, it won't be because the math was wrong. It will be because the math was trusted too much. History doesn't repeat. It waits for us to forget what it taught.